Hey folks, Joe Valley here. Thanks for joining me for another episode of the Quiet Life Podcast. Today, I've got Tim Nelson from AVASK Accounting on the line, talking about a variety of subjects. I made sure that we didn't stick to anything too long so we didn't get too deep into the weeds. But one of the things we talked about was a foreign entity, whether it needs to open up a US entity in order to sell on Amazon and on Shopify, and what form it is you need to fill out as a foreign entity to avoid that. We also talked about what it's like to move from selling in the US to internationally. So I didn't say overseas, selling internationally, and where people tend to go to first and where they get the most bang for their buck. And spoiler alert, the answer is not Canada, and it is not Mexico. So it is actually overseas. Another thing we talked about was the benefit and cost of setting up your books in arrears, meaning that if you're running a business and you're not using proper accounting now, you know that when you go to sell the business, your buyer's going to have a problem with that, or your advisor at Quiet Light is going to shake you by the shoulders and say, come on, let's get this right so that the value of your business is higher and so that the buyers trust you. So, I gave a scenario to Tim in terms of this is the size of the business. This is how old it is. The books are kind of a mess. There's no accrual accounting and it's screwed up in this area, in this area, in this area. How much is it going to cost? How long is it going to take to set this up in arrears? And how many years back should we go? So we gave some good answers on that. We went back and forth a little bit on it all together. And then we talked about how important it is to get a valuation for your business and how to reverse engineer a path to that. So I'm just going to say right now out loud, folks, if you're listening to this podcast and you own an online business and you've never gotten a valuation for your business, what the hell is wrong with you? Come on. Your business is your most valuable asset. Get a valuation for it so you'll understand how close or how far you are from your goals. If you haven't set exit goals, come on, let's set them and reverse engineer a path to them, starting with a valuation. So you can go to quietlight.com/sell and fill out the valuation form. You'll end up talking to one of the entrepreneurs turned advisors here at Quiet Light, and all of them are going to help you with good advice. There's no trying to get hooks into you for a commission. Most conversations lead with, I would push this lever, pull that one, so that in 6, 9, 12, 18 months, your business is going to be worth X amount more. Of course, if you're just emotionally burnt out, tired, and ready to sell and you must, we're going to help you. That's what we're here for. If you're not ready to have a conversation with a human, go to exitpreneur.io/QL pod and get a free digital version of the Exitpreneur's Playbook. It's a valuation in a box, in a book. In this case, it'd be the digital version. If you do it from your mobile device, you can download it onto your Kindle, your iBook, your Nook, whatever it is that you read. It's free digital version, full copy of the book. So go to exitpreneur.io/QL pod and get a digital version of the book if you're not ready to talk to one of the advisors here on the team. Okay, I've rambled on enough at the beginning of this intro. Let's jump to talking to Tim Nelson from AVASK Accounting about all these interesting things. Here we go. Hey, Tim, how you doing today?
Good, Joe. How are you?
Good, man. Appreciate you joining me on the podcast. Can you give the folks a little bit of background on yourself and AVASK Accounting?
Sure. So again, my name's Tim Nelson. I'm a CPA here in the United States. I'm also CEO of AVASK USA, AVASK being a global accounting firm that helps e-commerce sellers with any kind of tax or accounting needs, along with expansion. A lot of e-commerce sellers are always looking to sell in certain countries and grow their business, and we can help guide them along the way.
Now, AVASK was originally a UK company. Is that correct? It was founded over there by Melanie or other folks?
Yes, no, it was founded by Melanie in the UK quite a few years ago, and then the company has now expanded through many countries, including the US here.
So is the US part of it a startup entity where it was like, hey, we should have a location in the US? Or did you previously own an accounting firm that got absorbed by AVASK?
Right. I previously owned an accounting firm that got absorbed by AVASK. I had my own practice for about 6 years that was focusing on e-commerce, on sales tax when that was a huge issue, and was providing resources and answers for our clients. And as that company grew, AVASK reached out and absorbed me so that we can have a global presence to help sellers with any tax needs they have throughout the globe.
Okay, so we're going to just do random topics here because we've had what I would call bookkeepers on the podcast before, and everybody that's listening knows that I'm a preacher when it comes to outsourcing your bookkeeping. So y'all can go to AVASK Accounting and check that out. We're not going to harp too much on that. First subject I want to talk about is foreign entities that think that they need to open a business in the United States in order to sell on Amazon and to get an EIN number. Talk to us about that aspect of it. So you live in the UK and you're expanding from selling in Shopify in Europe and Amazon in Europe, and now you want to go to the US. Do they have to open an entity in the US in order to do it?
No, they don't. Actually, it's pretty simple, actually. What we can do for people like that is get them the EIN number they need so they can get themselves set up on Amazon Seller Central, register them for a couple of states for sales tax that we can file for them. They probably have to fill out the W-8 DENE, which tells Amazon not to withhold 30% for taxes for that company. Really, that form kind of says, hey, don't worry, we're going to take care of the tax ourselves so that when you sell in the US, you get all your money from Amazon. And then really just file an informational return at the end of the year to say, hey, listen, we had sales here in the US, but we're not paying tax here. We're going to pick it up here over in the UK. And really, that takes care of everything on the US side.
So it's a foreign entity getting an EIN. They absolutely don't have to open up a US entity.
That's correct. And that's why there's that informational return saying, hey, listen, we're a foreign entity. We had sales here in the US. I know you, the IRS, are going to be looking for some kind of return so they can get some tax. We're going to file this informative protective return saying, yep, we did have these sales, but per our tax treaty with the US, we're not going to pick it up here.
Cool. All right. That's big news. First news to come to the audience. That I didn't know this. We've always looked at people starting in the U.S. when they're overseas and then want to open up in the U.S. Didn't know that they could get an EIN. And now, why is it important? Why is it necessary for a foreign entity to even get an EIN to sell in the U.S.? Or is it not?
Well, it's important because we have to register you for sales tax. You can't register in the States for sales tax without an EIN number. So as you mentioned before, in the type of platforms that someone may be selling on, especially Shopify, you're going to need an EIN number. You're going to need to register for sales tax because the biggest difference between Shopify and Amazon is a lot of, especially no matter where in the globe you are, everyone knows about marketplace facilitator, meaning Amazon's going to take care of the sales tax, they'll remit it, you don't have to do anything. Shopify is not a marketplace. And so go back to now our old laws with sales tax. If you have inventory somewhere, you got to register for sales tax. If you have a certain amount of sales in each state, you may have to register for sales tax. So that Shopify side will probably trigger quite a number of sales tax registrations, which you then need an EIN number to register for sales tax.
Gotcha. What sales tax software do you recommend these days? Is it, if you have Nexus, TaxJar, what's your favorite?
AVASK. AVASK has its own sales tax software that we created to file. Yes, absolutely. Okay. So as clients do, not to give a sales pitch, but as clients do sign up with AVASK, we try to take care of everything under one roof. Bookkeeping, tax return, sales tax, all done in-house. We don't outsource anything. We take care of it ourselves.
So you've been exposed to a lot of e-commerce entrepreneurs over the last decade. What exactly is like the biggest mistake they make tax-wise? Let's just call them, if it's a U.S. entity. What are the things that they screw up and that is so easy for them not to screw up with that you're like, what the hell? Why did you do that?
Yeah, two things. The first is recording the correct revenue. I find that a lot of people will contact us here at AVASK saying, hey, I recorded all my sales on AVASK, and I recorded all my sales for Amazon, And whatever was deposited into my bank account, I picked up as my revenue. But I filed my return at the end of the year, and the IRS sent me a letter saying I owe additional tax, that they don't agree with my return. And what it is that they just don't record their revenue correctly. They don't realize that Amazon first takes their sales and then takes their fees out, and then you get sent your money. But then Amazon will report to the IRS, hey, here's what your sales are, which is before Amazon takes their fees. And so IRS just says, okay, just pay us the tax on the difference, which isn't really fair to the seller because they're missing out on a ton of expenses. So I'd say just revenue recognition is the first big mistake.
Yep.
The second is
let me address that and just say that I'm guilty of it as well. In my last e-commerce business that I sold to Quiet Light a decade ago, almost actually 12 years ago now. Man, I'm getting old. I did the same thing. I recorded deposits to my account because it was easy and I was being lazy, and I didn't have an e-commerce bookkeeper. And then I was surprised by additional taxes that I owed at the end of the year.
Sure, and that's a fine mistake, because really almost in every other profession that you record your revenue in, that's the right way to record it. Whatever gets deposited into your bank, that's your sales. That's how it's taught in school also. It's just that e-commerce is it's different, and that being one of the biggest reasons how it's different is how you record your revenue. And I mean, even this tax season up till April 15th, I would say we've gotten about, let's say 15 to 20 clients who contacted us saying, hey, we got a letter from the IRS. I don't know what it means. They're asking for a lot of money for tax. How do we respond? And it's a simple resolution because we've seen it so many times, and it's just a matter of recording your revenue correctly.
So I just had Jamie from A2X Accounting on the podcast. Actually, I shouldn't say just. It was probably 2 or 3 months ago, and I've got a full understanding of that software. I'm going to guess that AVASK has a similar software, or do you recommend A2X?
Oh, we have a similar software and recommend A2X. A2X does a great job in making sure that revenue numbers from, let's say, Amazon get put onto either QuickBooks or whatever bookkeeping software you're using. So yeah, okay. It's a very good software.
Yeah, I totally agree. So for those in the audience, it's a small monthly subscription, and what happens is that it's tied to your seller account, and it automatically pulls in all of the revenue minus all of the fees into QuickBooks or Xero or whatever accounting software you're using. And then you've got to do your normal, general expenses that you've got as well. So good stuff. All right, Tim, number 2, there were 2 things that you said people make big mistakes tax-wise.
Yeah, second thing is inventory. Being able to track and, book your inventory correctly is the second and probably even more common mistake or error that people make. And tracking inventory, I'm sure, isn't easy. There's tons of software out there, but making sure that your books are accurate so you can, track your cost of goods sold and stuff like that is so important, because it's easy to turn around and go buy inventory. Hey, I just ordered X amount of inventory and great, I can be off and selling, but keeping track of it is a tricky thing, especially if everything's not sitting in Amazon. Let's say you've got some in your garage or some under your bed or something like that, or some's in transit on the way, and trying to keep track of that all can be a bit challenging, but very important when it comes to your books, especially if you're trying to analyze your financials every month. You want to see how profitable you are. You want to see how much inventory you are. You're going to base your decisions on those numbers, and keeping track of those numbers and those values is very important. I know there's a bunch of softwares out there that can help, and it seems to be a common challenge for a lot of the clients that we've dealt with to keep track of the inventory, whether they're using an Excel spreadsheet or they're using something like Inventory Lab or another inventory software solution. I find that sellers have a job of it to try to keep track of their inventory.
Yeah, I guess I'm going to just, every time you mention something, I'm just going to talk about past guests on the podcast. So we had the founder of SoStock, inventory management software, Chelsea Cohen, on the podcast probably 6 or 7 months ago. But and she's somebody that came from the e-commerce space and had this problem, and her and her business partner seem to have solved it with software as a service called SoStock. But Tim, it's only one piece of it. Like, inventory is critical. First, I would guess that 99% of the entrepreneurs all right, I'll say 95. I'll be generous. Listening to this podcast that have e-commerce businesses, meaning physical products, that they don't have an inventory aging report, which is kind of critical when you sell your business or when you're going to order more inventory or determine what inventory to order. And number two, if they're doing any kind of accounting on their own, any bookkeeping on their own, they're not doing inventory on an accrual basis in their accounting software. How painful is it to set up accrual accounting, especially for the inventory, because it always changes, in the accounting software like QuickBooks or Xero?
It's not too painful at all. I mean, really, all you have to do is make that decision saying, okay, I've got to start recording my inventory on an accrual basis, and you just start doing that. Instead of expensing it, you start capitalizing it, not to go into too many accounting terms, but really that's it. And then you just really get to write off your inventory as you sell it. And so instead of expensing everything at once, you get to expense everything when you sell it. And that's really just how you move over to the accrual accounting for inventory.
Well, what about the inbound freight? Oftentimes I see the freight on a cash basis where it, in my view, should be on an accrual basis because you get this big lump sum and then zeros. Meanwhile, your inventory might be in there on an accrual basis. Do you do freight as well as part of that inventory cost? Maybe call it landed cost of goods sold?
So a lot of people do ask that question about landed costs. We expense the landed cost as freight, just a freight expense, but the because it doesn't really, some people can look at it as, hey, that's part of the cost of getting your inventory, but really the unit, whatever that is it's just the cost of that unit, not the freight that should be capitalized on for inventory. Now, some clients may disagree and say, hey, I want the landed cost to be included in there, and that's fine if they want it that way, but you can definitely expense it.
Yeah, so if you're going to sell your business and you run a profit loss statement and you've got cost of goods sold in there on an accrual basis, but your freight is lumpy, it's going to affect the value of your business based upon the timing of that exit. So let's say you order inventory every 4 months, and that your freight cost is $10,000 every time you do that. So you're going to have a $10,000 expense and then no expense for 3 months. So if you go to sell at the end of that 3-month period, at the beginning of that 3-month period, or just after that $10,000 expense, let's say that's in January, but you're listing your business for sale in February, that $10,000 really, if it's 4 months worth of inventory in the future, it should be $2,500 in my view. The math, Tim, is pretty simple. If you're selling your business for a 4-time multiple, now you've got $7,500 of expenses on the books that is really for inventory, inbound freight that's going to happen in the next 3 months, not in the past 3 months. And that 7,500 times 4 is $28,000 off the list price of your business. Now, a good qualified advisor will make that adjustment in the add back schedule. Mm-hmm. I would highly recommend that they do that. And this is the challenge, guys, when you go to sell your business on your own, is that you don't get these little nuances unless you listen to this podcast with Joe Valley and Tim Nelson from AVASK Accounting. You've got to make these adjustments. Otherwise, little tiny mistakes like this are going to add up to hundreds of thousands of dollars. When you agree, Tim, I see you making notes there. I would love your feedback on that.
Yeah, Joe, you make a great point because yes, the landed costs and the shipping, you'd want to do add backs, and that's a big part of selling your business. And having somebody that either could represent you or know what your numbers are is so important. To know what those add backs are, whether it be those landed costs, whether it be officers' compensation, the pay you're taking, or a number of other things. Making sure when you're talking to, let's say, an aggregator or a broker of some kind, to know your numbers or to have somebody who understands your numbers in your business, so that when you go to sell the business, you want the biggest bottom line number you can, obviously then times some multiple, to be able to maximize the value of the business when you try to exit. So yeah, just agreeing with you that knowing those add backs and understanding your numbers it goes a long way when you want to exit. This
is a perfect time to jump to our live commercial break we're doing now with giving away the free digital copy of the Exitpreneurs Playbook. There is a chapter on ad backs. It covers 18 different types of ad backs, including when your cost of goods sold goes down and how to do an ad back for that period that's going to carry forward and benefit you financially. If you're going to sell your business on your own, please download the free digital copy of the Exitpreneurs Playbook. If you do it on your mobile device, you can read it on your Kindle, on your Nook, on your iBook, whatever it is. Just go to exitpreneur.io/QL pod, like Quiet Light Podcast, QL pod. If you are a buyer of a business and you're out there hunting for your next business to buy, and you want to get a better understanding of how foolish somebody is when they say, I got this, and they're selling their business on their own without reading the book and without representation, you're going to see a whole bunch of ad backs that they missed. And you're just going to say, yeah, sure, I'll pay your price, because you know you're getting what I call an ignorance discount when that person is selling the business on their own without getting some sort of training that they would get from a book like the Exitpreneurs Playbook. So fantastic. Go to exitpreneur.io/QL pod and get your free digital copy of the Exitpreneurs Playbook. All right, Tim, when it comes to expanding overseas, lots of folks listening are in the US. They're hoping to expand overseas. And you know what? Let me just say internationally. Let me pull that back. I'm going to say internationally, because hell, they may go north or south at this point. Mm-hmm. Where are your clients that are US-based clients that are expanding internationally? Where are they jumping to first? What countries, what locations, what continents are most effective, where they're getting the potential most bang for their buck with the fewest complications?
I think the Europe is the country or continent that they're going to first. And knowing which countries to start putting your inventory in goes a long way. Having the team over in the UK and our offices throughout Europe help sellers make the right decisions when first getting set up overseas. I think a lot of it has where they put inventory, in my understanding, it has a lot to do with how the VAT and other taxes work. And I know that it's constantly changing over there with the type of taxes that are going along. And so having someone kind of hold your hand and guide you on the right way to get set up, especially with inventory, goes a long way.
Yeah, I'm going to have Melanie on the podcast in a few weeks, and she's going to do a deep dive on inventory locations to minimize taxes and things of that nature. But let's just go with the acronym VAT that you just used. First, tell us what VAT stands for and why it's really important for people that sell in the US that are expanding over to Europe to understand.
Got it. And being a U.S. tax person, my VAT knowledge is a bit limited, but I know the basics. So VAT is value added tax. It's basically our sales tax over there. But the one biggest difference that you have to realize is that VAT is added already. It should already be included in the price of your product. Where here in the U.S., we buy something, you add sales tax to it, you have your final price. Overseas, VAT is already added in. So you want to put your price of your product to include or cover VAT before you sell it.
Very good. How many people make the mistake of going overseas on their own and think, okay, well, I sell it for $39 here, I'll sell it for 39 euros there, and don't even think about VAT? Is it a big mistake you see people make often?
It's a mistake. I wouldn't say it's a big mistake. I think a lot realize that, hey, there's something going on there that I'm not understanding too well, and seek out the guidance beforehand. But and any of the other nuances that trying to expand to the overseas is what really people don't realize before they make that decision on inventory placement, as you said you're going to speak with Melanie about, and stuff like that. I think that's really where people's headaches begin, and trying to getting those answers before you actually do expand, I think, is critical.
Well, let's jump topics here and talk about the business owners or acquisition entrepreneurs in the audience that are either operating on Amazon or buying an Amazon business, but they really want to push and expand on Shopify, but all of the inventory is at Amazon. I understand that Shopify and Amazon have worked something out so that you can do fulfilled by Amazon on Shopify stores. Is that right?
Yeah, Joe, that's correct. So Shopify is really great in how they integrate with so many other places, Amazon being one great example. And so many sellers, at least here in the US, are taking advantage of that since Shopify, you know, offers such cheaper fees than Amazon. So when you make your sale through Shopify, they're realizing more of a profit. And their partnership with Amazon is that, hey, great, I can make my sale on Shopify, but have Amazon ship from their warehouses to wherever the customer is located, which is such an advantage. But from a tax perspective, it could cause quite a challenge because Shopify is not a marketplace facilitator. Amazon being the marketplace facilitator, generally you don't have to worry about sales tax. Shopify, you do, because it's not covered by marketplace facilitator laws. And in theory, having inventory shipped through Shopify from Amazon would cause you to have nexus, I hate that word, but nexus in all the states that Amazon has warehouses, since you're using that inventory to fulfill your Shopify orders.
Yeah, but if you're selling on Amazon already, you already have Nexus. So
Right.
the important thing here is being able to expand your Shopify store. In this case, while not having to deal with the headache of setting up a new 3PL or, God forbid, shipping product out of your garage because you never get to go on vacation and business is always there. Not to mention that you have to carry the groceries in the rain and you can't park in your garage. So it seems to me like a good deal and a good situation. What other platforms other than Shopify allow you to fulfill by Amazon that you know of?
I believe WooCommerce does the same thing, and I'm not sure if Wish does as well, but it's really Shopify that most people are focusing on. And when you just look at the numbers and do the research, it's why Shopify is, I think, the largest growing platform right now, or the quickest growing platform right now. People seem to be turning to that and looking to expand that marketplace more than any other.
Good. All right, let's jump topics again. You have a lot of clients that you have access to, and you see their numbers and you see what platforms they're selling on. So right now, if you were one of them, would you sell or expand to, let's say you're selling on Shopify, you're selling on Amazon, and you want to jump to a new channel, and that the options that are Walmart or Target, which one are you going to first?
I would go to Walmart first. But let me just first say, don't stop selling on Amazon. I would say 95% of sellers who sell on multiple marketplaces, 95% of their sales still come from Amazon. It's great that they're trying these other marketplaces, but it still seems that Amazon is just carrying everything for each business that we deal with. But I think Walmart is just really trying to get themselves together and understand how it all works. And a lot of people are trying Walmart. Yeah, maybe the sales aren't there yet, but I think that would be the platform that I would choose over Target. Have you, Joe? Have you had a lot of experience with either selling on either of them or seen any feedback?
Yeah, we've sold businesses that have revenues from all three channels or for their own website, Amazon, Walmart, and Target. Yeah, and I would lean the same way. Walmart as well, based upon experience and the transferability of the account. I'll say right now that anybody that has an Etsy store and sells on Etsy and you're really excited about that platform and you're pushing to expand it and grow it, it's incredibly hard to transfer it above board. And that's the way we act, is above board. We're going to do it the right way by, terms of service and guidelines. Once upon a time, everybody said you couldn't transfer an Amazon account, but the terms of service, said generally, and we got written permission from Amazon to do it. This was back in 2016, I think, Tim, when I published 10 Steps to Selling Your Amazon Business. I had all of their written communications right there. And in fact, we actually had a letter from legal that explained why people were afraid or Amazon was concerned, and they put, you can't transfer. It's really because if somebody was banned from Amazon, that they couldn't buy an Amazon business. That was their primary concern, that person would not be allowed back on the platform. But Etsy stores, you just simply can't do it. Have you had any experience with clients that sell on Etsy?
Not at all.
Not at all. Well, that's
Yeah.
for good reason in my view. All right, let's talk about just that dreaded subject that I think everybody should love, but generally they avoid as much as possible, and that's bookkeeping. How complex is it to set up? Let's say that I've got a business where I'm doing $3 million a year in revenue, and I've been doing it all on my own, and it's a mess, right? I haven't done it properly. I haven't done accrual accounting. I haven't deposited, or I've just been recording deposits instead of total revenue minus expenses. But I want to exit, and I want to go ahead and sell my business, and I'm going to work with that amazing guy, Joe Valley over at Quiet Light, and he's telling me I got to get my books in order, that it's cash accounting, and that everything's just set up improperly. And I refer them to you. $3 million a year in revenue, and no accrual accounting. How difficult is it going to be for you to flip it from cash to accrual, and how long will it take? And really ballpark dates and ranges here, and numbers. How much would something like that cost to just to get it done right retroactively?
And you hit the nail on the head with dates. Like it goes, hey, how far back are we going? Like, especially if you're selling your business, they're going to want to look at least a few years. Yep.
Let's say 24 months. Let's go back 24 months.
Exactly. Yep. So then we're going back 24 months and starting from the beginning. We're going to redo all the bookkeeping, because as much as we know that it's not accrual, and let's say we're not recording revenue correctly and stuff like that, what else is not being done correctly? Especially if it's going to be financials that we're going to present, we're going to want to do it from the beginning. And so we'd start everything over from there. And so really what you've got 24 months of bookkeeping for a $3 million client. And let's say it's going to be about $600 a month. Just doing some quick math. Let's say it's going to be about $14,000 just to get 2 years worth sets of books financially ready for presentation. Again, you'll have to amend your tax returns as well for what was filed, and to get it all up to date. And
why do you have to amend the tax returns?
Well, you're changing your numbers, especially if your revenue numbers aren't correct. You're going to have to amend your tax return to
But all I'm doing is getting this right, so that when I present my business for sale to buyers, it's done with accuracy and confidence to the buyers. And I'm not refiling tax returns for the IRS purposes. I'm just trying to exit my business.
Sure. So the first thing that we do here at AVASK, especially if we're reviewing financials for a buyer, is compare the financials they present to the tax return that was filed. And if there are large discrepancies there, that's a huge red flag. Why do you have financials saying one thing and a tax return saying the other? Somebody can say, hey, listen, it's for tax purposes, this, that, and the other thing. To me, that's a red flag. We want everything to match, be as clean as possible, so that the buyer has most comfort when they want to make their decision. Okay,
so let's just play around with that number that seems so big to so many people, but we're doing $3 million in revenue, and you're quoting $14,000 just to get the books updated and correct. So first of all, people, don't wait until you're emotionally tired, worn out, and just exhausted from the grind to get a valuation for your business and understand what it's worth, because you need to exit now, right? I'm done. I need to move on. Don't do that, because you want to understand the value of your business today so that you can march towards your exit goal. And when you understand the value of your business today, part of that's going to be an education on what buyers are looking for, and that is accurate P&Ls. And so if you just bootstrap it, that's everybody bootstraps. If you just wing it, because it's only you and you never thought you'd sell your business, and you're worn out and tired and exhausted, the last thing you want to hear is, yeah, you got to redo all of your accounting and spend $14,000 doing it in this particular case. But if you can get through that, what you're going to do, and Tim, tell me if you agree or not, but you're going to instill a lot more confidence in your buyers, and confidence and trust will pay for that $14,000 expense multiple times over.
That's completely correct. And having that trust and confidence from the buyer, I think, goes a long way. And even if it's 24 months of bookkeeping, we could turn that around in a month. And a month,
It's not too bad.
for as long as is for a lot of people who have been selling for a long time, it's not that long of a time. But for those clean, accurate numbers to instill that trust in the buyer, as you said, it's just going to pay for itself so many times over. We're working on that for 2 clients right now who are having us do that for that exact same reason, that they know they've been doing their own books. They know it's not 100% accurate. They feel that it's just going to cause issues once they present it to whomever buyer is looking into them. And they just want a nice, clean set of books so that it already answers all the questions that they may have before even giving the numbers. So like, here's the numbers. We're not expecting to, obviously there's going to be questions, but they're not going to be too many questions. And that, I think, goes a long way to help a buyer feel comfortable in what they're looking at.
Good. So let me just address the question that I can hear people asking, which is, why 24 months, Joe? Why only go back 24 months? The answer for me is because if I've got, 24 months worth of correct accrual-based accounting on your inventory, which is the biggest thing that sways your value up and down if you're on a cash basis, I can then extrapolate out the previous 24, 36, 48 months, however long you've been in business. That's easy for me to do. And I can make a note in the P&L that, adjustments were made to, 2018 prior, cost of goods sold are estimated based upon the most recent, 24 months. It's the most recent 24 months that are going to be most important to buyers because so much changes in this online world that we live in with a blink of an eye or an iOS update or Facebook changing the algorithms for advertising and things of that nature. How do you feel about the 24 months, Mark, Tim, or from somebody that's seen a lot of deals happen?
Yeah, Joe, they focus on those 24 months right away, and getting those clean and accurate so you can give a month by month comparison goes a long way in helping the buyer.
All right. So just a broad general question. What are some of the smartest things you've seen e-commerce entrepreneurs do in terms of working with AVASK Accounting and any preparation they can do to make their business look and feel more valuable to themselves or to a potential exit?
Sure. To go to the potential exit it's amazing how many clients don't know what the potential value of their company is. They know that they're doing well. They have great sales. They have a good profit. But if you ask them, hey, what do you think you can exit for? They don't know. They don't know what valuation they can go for. What expenses on their books, as you said, add backs can be taken off so that they could improve their bottom line number, and really just kind of getting an idea of what value your company can have is something I feel like a lot of sellers don't know. And it, as you said, it could take 1 or 2 good years to really boost the value of your company. And knowing the right time to sell and striking while the iron's hot, I think is a big thing that I think sellers should be aware of.
Yeah, I couldn't agree 1,000 times more. So guys listening out there, just go to quietlight.com/sell and fill out the valuation form. It's free. You're going to talk to an entrepreneur that's turned into an advisor, and they're going to give you honest advice. Here's an example. We had a client approach us that is in an Eastern Bloc country that runs a cosmetic business that ships product air freight from China directly to the customer. It's 18 months old, doing $5.5 million in revenue with about $1 million in discretionary earnings. You'd think that would be jumping all over that to get it sold. The real answer to, what's my business worth? It was answered, but it also included, look, if I were in your shoes, I'd hold off. Your company's young. It's only 18 months old. It hasn't really built a moat around it. And number 2, your recurring revenue is non-existent. You've got repeat customers that's hard to track, but you should have a subscriber-based program so that buyers can see that 10, 20, now 30, now 40% of revenue is from repeat customers from a subscriber auto shipment program. There's lots of things that we'll look at and see that we can help you improve the overall value of your business if you want to hang on. Of course, we're going to be there with you for you if you say, no, I'm out, I got to sell now. But the experienced entrepreneur turned advisor is going to give you real advice that's going to help you. And it's not to quickly sign an engagement letter and get our hooks into you for a commission. It's to help you build a better business, because selfishly, in the long run, your better business is going to sell for more, and that's going to help our business as well. But it's in your best interest to do that. So go to quietlight.com/sell, or if you're not ready to talk to a human about the value of your business, go to exitpreneur.io/QL pod and get a copy of the Exitpreneur's Playbook. All right, Tim, oh, good.
Yeah,
no, I got some thoughts here. Go ahead.
Yeah, you just made a great point that, hey, as much as we say knowing the value of your business and whether exiting is the right strategy, yes, it may not be the right strategy at the time, but you may hear the number and it's a great number on what you may value your business at. But as I've had a few clients before, guys, now's not the right time. You're just growing. You're just getting started. Things look bright in the future for various reasons, depending on the company. You may hear that number and just be excited, but it still may not be the right time. So even get that valuation, you'll get having an idea of what your business is worth, I think still also goes a long way, so you can plan accordingly.
Yeah, and the unspoken thing about valuations are that they're incredibly motivating, right? So it gives you an idea of what your business is worth today, what the weaknesses are in the business and how to shore them up, and what a difference it's going to make in the sellability and the value of the business. So it sounds odd, but getting a clear understanding of the value of what is likely your greatest asset is incredibly motivating, inspiring. It's going to get over those tough days and weeks and months, and sometimes years we all have as entrepreneurs. So I would say definitely get a valuation. Second is that, well, I forgot my second point already, Tim, because sometimes I just ramble on. So I'm going to move on to, Tim, we're running out of time. Do you have any last minute thoughts or advice for the entrepreneurs or potential acquisition entrepreneurs that are listening to the podcast?
Sure. I think one of the biggest things I can suggest is that expansion is a good thing. Looking to expand to sell into other marketplaces, but also other countries, is not as complicated as it may seem. I think a lot of sellers are sometimes afraid of the unknown and what's it like to sell over in Europe or in the UK and stuff like that, but that there's people out there that can help guide them and hold their hand. And expanding your business and growing your business is always the goal. And then hopefully with that expansion and growth, you can get to your exit and get the maximum dollar for exiting your business.
Sounds great. Good advice. Thank you, Tim, for coming on the podcast. How do people reach you? How do they connect with you? How do they learn more about what you do over at AVASK Accounting?
Yep, you can find us at avaskgroup.com, or you can email me at timothy.nelson@avaskgroup.com, or feel free to give us a call here in New York, where we're located, 914-664-1900.
Awesome. I'll put all that in the show notes as well. Tim, thanks for your time today. Really appreciate it.
Thanks, Joe. Appreciate it.